In 2025, precious metals dominated performance. They rose above equities. They moved ahead of industrial metals. They led nearly every other asset class. That is the headline most people saw. What followed was repetition charts, celebration, confirmation of what already happened. But the same data now points to a different setup. At the start of the year, gold and silver reached extreme, overbought conditions. Those conditions were documented. They were visible. They were measurable. And they matter for what comes next. Within commodities, the most relevant comparison is not broad. It is specific. It focuses on leadership. It focuses on volume. It focuses on where institutions actually participate. Gold represents precious metals. Copper represents industrial metals. Those two assets anchor their respective segments. They attract the deepest liquidity. They reflect institutional behavior. When the relationship shifts, the market is not guessing. It is signaling. That relationship is measured through the copper-to-gold ratio. It is not abstract. It is not theoretical. It is a long-used framework for comparing economic growth, exposure against defensive positioning. A new analysis published on TradingView examines this ratio in detail. The findings are precise. They are technical. They are supported by data. First, the copper-to-gold ratio is sitting in a long-term low zone. This zone is not new. It is a major support area. It has existed for decades. When the ratio reaches this level, probability changes. Historically, this positioning has increased the likelihood of a rebound. Not immediately, but structurally. A rebound in this ratio implies one thing: copper outperforming gold. Second, copper's own price structure supports this framework. The technical trend is clean. It is well-defined. It is bullish. Copper has established strong support between $4.60 and $5. That range is not arbitrary. It reflects prior resistance. It reflects prior acceptance. It reflects market validation. As long as price holds above this zone, bias remains intact. Third, institutional positioning aligns with the structure. The Commitment of Traders report from the Commodity Futures Trading Commission shows net bullish exposure. Institutional asset managers are long copper. This matters because these participants operate on long time horizons. They do not trade noise. They position around structure. When technical trends and institutional positioning align, the signal strengthens. These are the three pillars. They are independent. They converge. The first pillar is the ratio itself. The copper-to-gold ratio tracks preference, growth versus defense, expansion versus protection. Historically, when this ratio trades at long-term lows, it often reflects stress. Sometimes macroeconomic, sometimes valuation-driven. Gold tends to become overvalued during these periods, not because gold changes, but because fear concentrates. The weekly chart shows the ratio now testing a major support level. This level has been validated multiple times over the past 20 years. Each time, the interaction mattered. Every prior test was followed by a rebound. Not a marginal move, a significant shift. Each rebound favored copper. The pattern is documented. The history is visible. The structure is unchanged. From a technical standpoint, copper's price behavior reinforces the message. For several years, copper traded within a broad range. The market tested both sides. It absorbed supply, it built structure. Eventually, resistance near $3.30 was broken. That level held. Later, resistance near $4.60 was also breached. Once broken, these levels did not fail. They turned into support. This transition is critical. It signals acceptance. It signals a shift in regime. Since then, price has remained above these zones. Recent breakouts have held. The market has not reversed. As long as copper trades above the $4.60 to $5 range, the long-term trend remains bullish. This is not projection, it is definition. Trend is not opinion, it is structure. The ability of the market to hold above former resistance reinforces continuation. Not exhaustion, not reversal. The third pillar comes from positioning data. The Commitment of Traders report provides transparency. It shows how different groups are positioned. It separates speculation from allocation. Institutional asset managers currently hold a net long position in copper. This reflects conviction, it reflects alignment, it reflects expectation over extended time frames. When institutions hold long exposure during a well-established uptrend, it typically signals continuation, not distribution, not topping. This alignment does not guarantee outcome, but it shifts probability. When ratio support, price structure, and positioning converge, the signal becomes coherent. Together, these elements form the core conclusion. The copper-to-gold ratio at historical support. Copper in a clearly defined bullish trend, institutional investors positioned long. This combination argues for potential outperformance. Copper relative to gold. In 2026, short-term consolidation cannot be ruled out. Markets do not move in straight lines, that is acknowledged. But the broader environment is shifting. Industrial metals begin to matter when growth re-enters the narrative. When infrastructure becomes relevant. When energy transition moves from planning to execution. These drivers are part of the documented context. They are not assumptions, they are reference conditions. The leadership of commodities does not remain static, it rotates. In 2025, precious metals led. They reflected defensive positioning. They reflected overbought extremes. As conditions evolve, leadership can change. This is not a forecast built on emotion. It is an assessment built on structure. The data is published, the charts are available, the positioning is reported. What unfolds next follows process, not surprise. The relationship between copper and gold has reached a point that has mattered before. Each time, the outcome favored copper. That history does not promise repetition, but it provides perspective. The market is not silent, it is structured. And structure, over time, asserts itself. The implication is not dramatic, it is mechanical. When precious metals become crowded, price stretches. When positioning compresses, flexibility disappears. That is what extreme overbought conditions represent. At the beginning of the year, both gold and silver reached those conditions. This is stated, it is observable, it frames the comparison. Industrial metals did not share that positioning. They did not attract the same defensive flows. They did not reflect the same saturation. That divergence is why the comparison matters. Gold and copper are not chosen arbitrarily. They are the most actively traded assets in their categories. They attract institutional participation. They reflect where capital actually concentrates. Looking at secondary metals would dilute the signal. Looking at these two clarifies it. The copper-to-gold ratio compresses this comparison into a single measure. It removes narrative. It removes opinion. It shows relative behavior. When the ratio declines, gold leads. When it rises, copper leads. At present, the ratio is not neutral. It is not elevated. It is at a long-term low. This zone has acted as a floor repeatedly. Not once, not twice, over a span of roughly 20 years. Each validation has been followed by a reversal. Not immediately, but decisively. The ratio does not respond to headlines. It responds to capital allocation. From a purely technical perspective, this positioning increases the probability of a rebound. Probability, not certainty, but probability matters. Copper's own chart reinforces this probability. The long-term structure is described as clean. That wording is deliberate. It implies clarity. It implies order. The market spent years validating a broad range. This was not randomness. It was accumulation and distribution within defined boundaries. When price finally broke above $3.30, it confirmed a shift. When it later broke above $4.60, that shift strengthened. These were not isolated spikes, they were sustained moves. Once resistance becomes support, market psychology changes. Participants adjust expectations, supply dynamics adjust. The zone between $4.60 and $5 is now critical. It defines the trend, it defines risk. As long as copper remains above this area, the bullish bias remains. This is not interpretation, it is how technical structure functions. Recent price action has respected this structure. Breakouts have not failed, pullbacks have been absorbed. This reinforces continuation, not exhaustion. The commitment of traders' data adds a separate dimension. It does not rely on price, it relies on positioning. Institutional asset managers are net long copper. This is documented by the Commodity Futures Trading Commission. It is published, it is reported. These participants typically operate with longer horizons. They are less reactive to short-term volatility. Their positioning reflects conviction rather than impulse. When such positioning aligns with a technical uptrend, it often supports continuation. This is an observed relationship, not an assumption. The analysis does not ignore uncertainty. Short-term consolidation is acknowledged. Markets fluctuate, that remains true. But consolidation within an uptrend does not negate the trend. It reinforces it. The conclusion drawn from these combined signals is measured. It does not claim inevitability, it argues probability. Specifically, it argues for potential outperformance. Copper relative to gold in 2026. This is framed within a broader context, a context where growth regains relevance, where infrastructure investment becomes active, where the energy transition reasserts demand for industrial inputs. These drivers are referenced. They are not extrapolated, they are part of the stated environment. The leadership of commodity markets has shifted before. It does not remain fixed. Periods dominated by defensive assets are often followed by periods where growth-linked materials lead. The ratio captures this rotation. What matters is not the story, it is the structure. The copper-to-gold ratio at historical support, copper prices above key support zones, institutional positioning aligned. These elements do not contradict each other. They reinforce each other. This does not invalidate gold, it contextualizes it. Gold led when conditions favored defense. That leadership produced strong performance. That performance created overbought extremes. Now the comparison resets. The analysis does not suggest abrupt change. It suggests gradual rebalancing, a shift in relative strength. The ratio does not need to surge. It needs to turn. That turning point has historically occurred near current levels. That is the observation. The market does not need new narratives. It responds to existing conditions. Those conditions are documented. They are visible. They are published. This is why the comparison matters now. Not because of excitement, but because of positioning. Industrial metals do not require euphoria. They require alignment. The alignment is forming. Copper does not move in isolation. It reflects industrial demand. It reflects infrastructure cycles. It reflects energy systems. Gold reflects protection. It reflects caution. It reflects capital preservation. When relative preference shifts, price follows. The analysis does not predict timing. It does not specify magnitude. It identifies structure. Structure defines possibility. In this environment, the possibility favors copper, relative to gold, as the calendar moves forward. The evidence does not rely on a single indicator. It relies on convergence. Ratio support, price structure, institutional positioning. When these align, markets tend to respond. Not instantly, but consistently. This is not a call, it is an observation. The data exists, the framework is established, the comparison is clear. What unfolds will follow documented processes. Not speculation, not surprise. The market has seen this configuration before. Each time, it mattered. The present setup carries that same structural weight. Quiet, measured, visible, and already in place. The closing implication remains grounded in what is already stated. The environment is described as increasingly favorable. Not guaranteed, not accelerated, favorable. That distinction matters. The analysis does not deny volatility. It does not dismiss pauses. Short-term consolidation is explicitly acknowledged. Markets breathe. They compress. They release. Consolidation within a defined structure does not weaken that structure. It tests it. Copper's ability to hold above former resistance zones is part of that test. So far, those zones have held. That is documented behavior. The broader comparison continues to rest on leadership. Which segment absorbs capital? Which segment reflects institutional intent? In 2025, precious metals absorbed that role. They outperformed. They benefited from defensive demand. They reflected uncertainty. That phase produced results. Those results are not disputed. But markets do not reward the same positioning indefinitely. When extremes develop, relative opportunity shifts. The copper-to-gold ratio captures this shift without emotion. It does not ask why, it shows what. At present, it shows compression. It shows a long-term low. It shows proximity to a level that has mattered repeatedly. Each time this ratio interacted with that zone, the outcome followed a familiar pattern. Copper strengthened, gold lagged. This is not framed as coincidence. It is framed as repetition. Repetition in markets does not guarantee replication, but it informs probability. The analysis is careful with language. It speaks in terms of likelihood. It avoids absolutes. That restraint is intentional. It preserves credibility. Copper's bullish structure is described as clean. That word implies absence of distortion, absence of conflicting signals. The market validated a range. It broke out. It retested. It held. This sequence matters. It defines trend. The $4.60 to $5 area is not symbolic. It is functional. It defines where buyers have repeatedly stepped in. As long as price remains above that area, the underlying bias remains bullish. This is how structure operates. The commitment of traders' data adds confirmation. It does not replace structure. It supports it. Institutional asset managers holding net long exposure reflects alignment with that structure. These participants typically do not front-run noise. They respond to established conditions. When their positioning coincides with technical strength, the signal strengthens. That relationship is noted, not exaggerated. The analysis does not claim institutions are infallible. It simply notes their current stance. That stance is bullish on copper. When all three elements align, the conclusion becomes coherent. Not dramatic, coherent. The potential outcome described is relative outperformance. Copper relative to gold, not absolute price levels, not specific targets. Relative strength is the focus. Leadership rotation, not collapse, not crisis. This distinction maintains neutrality. It avoids sensationalism. The broader context mentioned includes growth, infrastructure investment, and the energy transition. These are not predictions. They are reference drivers within the commodity space. Industrial metals are inherently linked to such processes. That linkage is structural, not narrative-driven. When those processes regain emphasis, industrial inputs tend to matter. Copper sits at the center of that category. Gold does not disappear in such environments. It simply yields relative leadership. That is the framework presented. The analysis does not attempt to time the shift. It does not assign dates. It references the year 2026 as a window, not a trigger. This is important. It preserves realism. Markets transition. They do not flip. The copper to gold ratio turning does not require immediate price movement. It requires relative change over time. The fact that the ratio is currently testing a major support level increases the relevance of the moment. It does not force an outcome. It highlights significance. Significance comes from history, from repeated validation, from documented response. Over 20 years, this level has acted as a floor. Each interaction has mattered. That is the observation. The market has reached that zone again. That is the fact. What follows is governed by structure, not commentary. The analysis concludes by acknowledging the broader environment, one where industrial metals could regain leadership, one where growth-linked materials become more relevant. This conclusion does not negate the past. It contextualizes the future. It does not dismiss gold's role. It reframes its relative position. The weight of the argument comes from convergence, not from assertion. Technical structure, ratio positioning, institutional exposure. Each element independently supports the same direction. Together, they narrow uncertainty. This narrowing does not eliminate risk. It clarifies probability. The tone remains measured. The delivery remains controlled. There is no call to action, no urgency, no instruction. The information stands on its own. The market is already expressing these relationships through charts, through positioning, through ratios. Nothing here requires belief. It requires observation. The processes described are already unfolding. They follow documented patterns. They follow established mechanics. Whether the outcome repeats exactly is not claimed. That it is repeated before is. That context provides perspective, not prediction. As the analysis closes, it returns to structure, not speculation. The copper to gold ratio sits where it has mattered. Copper trades above strategic support. Institutions hold net long exposure. These are present, tense facts. They define the environment. They frame the comparison. They support the conclusion. The potential for copper to outperform gold in 2026 is not presented as surprise. It is presented as alignment. Alignment between price, positioning, and historical behavior. That alignment does not shout. It does not rush. It exists. Quietly, visibly, documented. And markets, over time, respond to what exists, not to what is assumed. The information is published. The data is available. The structure is in place. What comes next follows process calm, measured, already underway.